Moments ago, we had the November durable goods report coming in unchanged compared to a month ago, a year ago as well. Personal income and spending up just 0.3%. Want to bring in Jim Dunigan, PNC Asset Management Chief Investment Officer. Good to see you, Jim. Thanks so much for joining us.
Good morning, Maria.
Markets up today. We're looking at a rally at the opening of trading, and we did have these numbers on the durable goods story. What's your take on the economic data of the day, and what does that tell you about the markets?
Well, I think it's no doubt a positive. The durable goods, although flat, the estimates were for it to be down 0.6%. So it supports our forecast of a 2.7% increase in GDP in the fourth quarter, and we're looking for, a slow but steady 2.4% in 2014. So those numbers are supportive, as well as the numbers we've seen from the consumer side, spending at 0.3%. So some positive support for the economic backdrop that we have, but I think the markets here are more acting on what we've seen in little support in energy prices, crude oil over the last couple of days.
Do you worry that this economy is so weak going into the new year, and it should be at a faster pace here?
Well, we've been wishing for a faster pace for some time.
What's holding it back?
But this economy, as you know...
What's holding it back?
Say again?
What's holding it back?
Well, there's a number of factors. I think there's concerns, global concerns on economic growth in general. But if you look at the U.S. economy, some of the factors, autos, housing, the consumer, all very positive here. The missing piece has been capital spending by corporations. We've seen much more on the M&A side than we have companies going out and investing in hard expenditures, particularly in the energy side. So there's a number of those factors that from the business side we have not seen, but the other side of the economy, not so bad.
I'm wondering your view of the Fed given these the data points. Do you think the Fed's steady as she goes, or do you think that they'll slow down the rate increases?
Our forecast for 2016 is for 3 more additional increases. The Fed has 4. I think the interesting thing for the market is going to be sort of this raise and pause cycle, which will be difficult. I think it's a sort of a full employment act for Fed watchers to determine exactly what the Fed will do in between meetings. But our forecast is for 3 here, and I think they'll hold to that gradual increase in rates over the next 12, 24 months.
Jim, the last 2 years we've had the first quarter be pretty lousy numbers. I think we may have even had negative numbers or flat this last year. So assuming we kind of have that same kind of cycle in 2016, it seems pretty difficult to me to believe that the Fed will raise interest rates in that environment in March.
I think it's very possible, like you say, that they could skip the March meeting in that environment, but it will be, again, all eyes on sort of the data, how employment does, what activity is. There's been some effort, as you know, to better seasonally adjust those first quarter numbers. Maybe with the winter we've had so far, we won't have the negative effects of the brutal winters we've seen over the last couple of years, but time will tell, and we'll have to see where oil is and where global economic environment is, particularly China, as we head into the end of the first quarter.
So, Jim, what are you expecting 2016 markets to look like?
Probably keep your expectations low, although we've had a flat year, and it's traditionally, followed maybe by an up year. I think we would look for low single digits, medium single digits, that 7-8% range on the markets. Earnings will be a bit of a question mark going into next year. We have a sort of a 3 or 4% increase in earnings.
Yeah.
And what the markets will pay for that. But I would keep your expectations low going into 2016, particularly in the backdrop of a presidential election year.
Well, you guys at PNC had this Christmas price index, which measures inflation using the 12 Days of Christmas song. From the report, the cost of a partridge in a pear tree is up 3.5%. Turtle doves up 11.5% compared to this time last year. Interesting report. Tell us about it.
Well, we've been looking at the cost of Christmas in the 12 Days of Christmas for the last 32 years, Maria, so it's a fun thing for us to do at this time of the year. It does, interestingly enough, track overall government CPI over that time frame, and as you note, this year it's only up 0.6%, so the cost of Christmas will be about $34,130. And that matches what we've seen in the overall consumer price index of 0.5% through November. So very little increase in inflation, absent not only in the overall economy, but in the Christmas price index as well. And the only wage inflation we saw were in the Lords of Leaping, which were up 3% over last year. So we see some wage increase, but not very much.
Jim, Merry Christmas. We'll see you soon, sir. Thank you.
Thank you. Same to you.
Coming up.